Alright, so let's look at another exercise here on issuing common stock in different types of scenarios, just to make sure that we understand the basic concept of how to journalize the issuance. So during the first year of operations, Eastern Data Links Corporation entered into the following transactions relating to shareholders' equity. The Articles of Incorporation authorized the issue of 7 million common shares. Again, authorized is the number of shares we're allowed to issue. Doesn't mean we're going to issue all of them, but that's how many we can issue. So 7 million common shares at $1 par per share, and we're allowed to issue 3 million preferred shares at $50 par per share. On February 12th, we sold 4 million common shares for $8 per share. Now, based on the information from exercise 1 that we did in the last video, pause the recording and see what you come up with. Alright, so now that you've paused it and worked it on your own, hopefully, let's talk a little bit about this. First and foremost, what did we receive? So the general form for the entry will always be what we receive. That's going to be our debit. Whether it be cash, equipment, services, those different types, that's going to be what we receive. That'll be our debit. And then our common stock, since it's an equity account, our common stock is going up as we issue it, so we're going to credit common stock. Then there's a difference between the two. We hit our PISIP account that we discussed in the prior video. So here, what are we receiving? Well, we're receiving $8 per share. So that means we're receiving cash. So we're going to debit cash. And how much cash did you come up with? Well, 4 million shares at $8 per share. That would give us cash of 32 million. That's what we raised. Again, we're ignoring issue costs at this moment in time. Now, what did we give in order to get that cash? Well, we gave out common shares, so we're going to credit our common stock. Now, do I need to credit my common stock for 32 million as well? No, absolutely not. The reason being is because this stock actually has a par value. So always pay attention. If stock has a par value, then we must carry the stock account at par, which is $1 per share. So 4 million shares times $1 per share. We would actually carry the common stock account at $4 million. Now, where does the difference go? Well, the difference goes into paid in capital in excess of par on our common shares. Now, that's the full name of the account. Again, by all means, I like to call it PISIP. PISIP common. It just makes it easier. So when I say PISIP, I'm referring to paid in capital in excess of par. So this would be our PISIP account for our common. Every company will call it something slightly different, and that's fine. But just know that that's the amount that the owner paid in above the par of the share. Okay? And it's just the difference. So a couple ways. One, you just take 32 minus 4. That means 28 million. If you want to prove that out, though, we know that it sold for $8 per share, minus the $1. So you carry this at market at 8. You carry this at 1. So this would be $7 per share in excess. $7 times the 4 million gives you the 28 million. So you can verify. We're not just plugging a number in, so to speak, but it truly is the difference in the market value of the stock and the par value. And that's the amount that goes into PISIP. All right. February 13th, we issued 40,000 common shares to attorneys in exchange for legal services. Now, what we're assuming here is still the $8 per share, so it's the 12th, 13th would still be $8 per share. I really wish the problem would tell you the value because stock prices do fluctuate, so we couldn't guarantee that would be 8. But the way they've written the problem, they're still going to assume here the $8 per share. Now, when we do our stock in exchange for services, we use the most proper valuation. In other words, should we use the price of the legal services or should we use the price of the stock? Well, if the legal services are a true reflection of the value served, so if the attorney charges $200 an hour and they worked 1,000 hours for you, that's the true price of that attorney, so you could record the services there. If we do not know the true value of the service or the good we're getting, then we have to use what we call the market value of the stock. So here we have no clue what the actual legal services costs are, so we have to assume that they equal that $8 per share. So what are we getting here? Well, we're getting legal services, so we're actually getting an expense. I know that sounds weird, but instead of having to pay the attorney in cash, We're actually just giving them shares of stock, but it's still legal expenses for our company. So we're going to hit that. And again, it would be for 320,000. Why is that? Well, it'd be 40,000 shares times the $8 per share. Okay. And again, we're assuming that $8 is the market value during this time period for these entries. Now, what are we giving in place of that? Well, instead of paying cash for these legal services, we're giving out common shares. Now, the catch here, though, our common shares must be carried at par, so we're going to hit the common shares account for 40,000. So common stock, 40,000. That's the 40,000 shares times the $1 par value. Now, where does our difference always go? I hope you're okay. I'm going to switch over and use the abbreviation instead of typing that out every time. Please follow whatever, if you're watching this from afar, follow what your instructor says. But in this case, I just call it PICIP common. So if you're in my classes, by all means, you can call it PICIP for common or PICIP for preferred when we're talking about the issuance of actual stock. And again, it's just simply the difference here, 280,000. All right. So keep that in mind. We either do it the value of the stock or the value of the service, whichever is more readily determinable. So whichever is the most representative of the fair value of the actual service provided. Okay, same concept for land or equipment. If you know the true fair value that everybody else pays for that equipment, that's what you record it at. But if there's no set fair value like land is based on someone's opinion. So land, typically we would use the fair value of the stock because that's more of a actual determinable price than the fair value of land. Fair value of land would be an appraisal. Well, if you have 3 appraisals, you're going to get 3 different numbers. Whereas the stock price is a stock price, and at that moment everybody pays the same price. So that's one way we could follow through. All right. So February 13th, again, we sold 80,000 shares of common and 6,500 shares of preferred for a total price of $1,040,000. Whoa. Now this is a little bit of an issue. It doesn't tell us how much the preferred shares sold for, but we can assume that the common shares sold for $8 still. We're following that same concept that we've got an $8 market value here. So we can find the common information first. So anyway, we issued them for cash, so that would be $1,040,000 for our cash there that we received. Now, what else do we need to hit? Well, we need to hit common stock, and we need to hit preferred stock. Now, odds are we're going to have, since we got par value, we will have some PICIP accounts here. So let's start with our common stock. How much would we record it at? Well, at the moment, we have to know a market value of at least one of the 2 shares. So we're still assuming that $8 per share for our common stock. Again, it probably would have changed in the real world, but textbook learning at its best sometimes. So they've kept it at 8 for these first 3 transactions. So $8 per share times how many shares of common did we issue? We issued 80. So when you multiply that out, 8 times 80 gives us what? Oh, why did I say 8? Duh, our par value is 1. Sorry about that. My apologies. Rewind. Delete that. It's $1. Why did I do 8? I was looking at our $8 per share. That's what we did here. My apologies. This is 8 times 80. I'm just off the line when I'm typing. So it's a $1 par, so that would be 1 times 80. So that would give us 80,000. Whoops. I cannot get in the right place. My apologies, y'all. There we go. 80,000. So keep in mind, common stock is carried at its par value. When I looked up, I was like, oh, what am I doing? So now we know. So we got that $1 at 80, so that gives us 80,000. Now, obviously there's a difference, so that's going to be our PICIP for our common. So we know that our common stock has an $8 value minus the 1 here for our par, so that means 7 times the 80,000. And when we take 7 times the 80,000, we get 560,000, right? I did that math in my head correctly. So now we know everything that went into the common stock. Now, how would we come up with the preferred? Well, preferred is just the same. You're going to carry the preferred stock at its par. So we issue, let's see, preferred stock, if we scroll back up, Our preferred stock has a $50 par per share. So we know our preferred stock is carried at 50, and how many shares of preferred did we issue? We issued 6,500 of preferred. So we're going to take 6,500 times the 50, and when we multiply that out, you should get 325,000. Double check my math because, I'm human. I do make errors sometimes. So 50 times 6,500. Now, by definition, the difference between the market for the preferred and the par is what we would record. But the problem is we don't know that. So in this case, our price up for our preferred stock, and it's the same concept, paid in capital in excess of par for our preferred, comes in at whatever is needed to sort of balance the equation out. So in this case, we need 75,000, I believe, to balance this out. So if we go in there and add that up, we should come back to the 1,040,000. And this is basically a plug. So how much was our par per account here? Let's see. If we took the 75,000, so our par is about $11 per share, $11.53. So basically, it looks like we sold our preferred stock for like $61-ish a share. But it doesn't tell us that. We have to back in. So this is truly, in this case, just a plug number, because we know the value of the common. So anytime you see an entry like this, you have to know one of the stock's value. You either have to know the actual market value of the common or the actual market value of the preferred, one of the two, in order to work that. All right. All right. So since the value of our common shares is known at 640, which is the $8 per share, we have to assume the market value of our preferred is 400,000. So that's just one way to look at that problem. All right, last thing. It looks like I've added some rows here, so let me back this up so we can get our last entry done, November 15th. On November 15th, we issued 425,000 of common shares in exchange for equipment, for which the cash price was known to be $4,008,000. All right, so here, instead of giving out or receiving, cash for our common stock, we're receiving actually equipment. Now, this is where we would record this at its actual value, okay, because everybody else pays $4.008 million for this asset. So would we if we were to pay cash. So that's the amount we would record the asset at. Also, we don't know the actual fair value of our stock at this point. It doesn't tell us. So you use whichever is most determinable. In other words, whichever is truly an accurate reflection of value. And then we're going to credit common stock. And again, we're going to carry the common stock at par. So we issued 425,000 shares at $1 par. So that's 425,000. And last but not least, the difference goes into our price at common. So you just take the difference there, which comes out to $3,583,000. So that's 8, 10, 10, 4. Yep, that works. So that's how that would work out, $3,583,000. So again, this is just some examples of different issuance of stock so that y'all can get comfortable with journalizing the issuance.